Hi everyone. So in this video, I want to talk about few economic concepts very quickly. Starting off with consumer surplus. What is consumer surplus? Consumer surplus is the difference between the price that the consumer is willing to pay and the price that the consumer actually pays. When there is a plus figure, we call that a consumer surplus. Let me explain. Let's say, for example, you are going to go to a shop and trying to order a mineral water bottle. Okay, price of this mineral water bottle is 50 rupees, whereas you are actually willing to pay 70 rupees. Price of the water bottle is 50, actual price that you are willing to pay for that water bottle was 70. So now what is the consumer surplus? Why don't you work it out for me? Willingness to pay was 70 rupees, price actually paid was 50 rupees. So then there is a consumer surplus of 20. If we take another example, something similar, imagine that you were willing to pay 55 rupees, whereas you had to pay 50 rupees for this mineral water bottle. Now what is the consumer surplus in the second example? Willingness to pay was 55, paid only 50, therefore the consumer surplus is 5. So very simple. Difference between the price that you are willing to pay and the price that you actually pay is consumer surplus. Same way there is a consumer surplus, producers also have a surplus. Okay, we call that a producer surplus. What is producer surplus? Very simple. Difference between the price that the producer is willing to accept and the price that the market will pay for his or her good. Example, imagine that I am willing to sell my product at 10, that is the price that I am willing to accept. However, market gives me a price of 20. What is producer surplus? Market gives me 20, I am even willing to accept 10, 20 minus 10 is 10, right? That is my producer surplus. Another example, I am willing to accept 1 for some product that I have produced. Market gives me 5. What is my producer surplus? 5 minus 1, which is 4. Bigger the consumer surplus, better off the consumer is. Bigger the producer surplus, better off the producer is. Consumer surplus and producer surplus. Guys, consumer surplus and producer surplus together, we call it the total surplus. Okay, where is the total surplus maximized? Total surplus is maximized at the equilibrium. Okay, total surplus maximizes at the equilibrium. Total surplus is a combination of consumer surplus and producer surplus. Maximizes only at the market equilibrium. Anywhere other than that, either the market is overproducing or the market is underproducing. Whenever that happens, there is economic inefficiency. That economic inefficiency, we call it the deadweight loss, right? Now I want to move on to a price ceiling and a price floor, right? So what is a price ceiling? Now think about these two words, price ceiling, which means ceiling is at the top. Now if you understand those two words, price ceiling. Okay, what is a price ceiling? Price ceiling is a legally established price. Let me say that one more time. A legally established maximum price that a good can be sold. Okay, that is a price ceiling, right? So which means beyond a certain level, beyond that price that is established, it is illegal for you to sell a good beyond the price ceiling. Okay, then there is another concept called a price floor. Price floor is a legally established minimum price. Floor is at the bottom, no? Ceiling is at the top, no? right? So what is a price ceiling? A legally established maximum price that a good can be sold. A price floor is legally established minimum price that a good can be sold. Okay, right. So now what I would like for you to do is to take a piece of paper and draw a demand and a supply diagram, demand and supply. And here is what I would like for you to remember. For a price ceiling to be effective, it has to always be below the equilibrium price and the quantity. For a price floor to be effective, there will be a straight line above the equilibrium. For it to be effective, price floor to be effective, price floor must be always above the equilibrium price. Let me explain as to why. To understand this, remember, when you put a price ceiling, you are trying to help the consumer. When you put a price floor, you are trying to help the producer. Okay? Price ceiling is there to help the consumer. Price floor is there to help the producer. Right. So let me now explain this more. Let's say, for example, market equilibrium price is 5. Now I told you price ceiling is there to help the consumer. No? If the market price is 5, if we are trying to help the consumer, the price ceiling must be below the equilibrium price. Meaning, if the market price is 5, you are trying to help the consumer, it has to be below 5. No, it has to be 4 or 3 or 2. On the other hand, price floor, you are trying to help the producer. So producer can anyway get the equilibrium price. For price floor to be effective, it has to be always above the equilibrium price. Okay, so if the equilibrium price is 5, price floor, legally established minimum price, has to be above the equilibrium, right? So if it is 5, price has to be 6 or 7 or 8 or anything above 5, right? So always remember, for a price floor to be effective, it has to be always above the equilibrium. Price ceiling to be effective, it has to be always below the equilibrium, right? So those are two things that I would like for you to remember when it comes to a price ceiling and a price floor, right? When you draw the graph, let's say, for example, if we are talking about price ceiling, there will be a black market price, there will be dead weight loss, right? How to show this in a graph is extremely important, right? So in this video, I'm not going to go to that. This is just a brief video to talk about these concepts that I want to talk to you today, right? So consumer surplus is okay, producer surplus is okay, price ceiling is okay, price flow is okay, right? The last concept that I want to talk to you about is about government taxes, right? So as you may know, governments tend to tax people for public purposes, right? Always remember, there are two main objectives of taxation. Two main objectives of taxation. Number one is to maximize the tax revenue. Number two is to minimize the dead weight loss. So what are the two objectives of taxation? Maximize the tax revenue. Number two is minimize the dead weight loss, right? Simply put, you understand the first one, maximizing the tax revenue. That's very straightforward. As a result of taxes, there can be economic inefficiency that gets created that has to be minimized. For you to minimize the dead weight loss and then to maximize the tax revenue, you must always tax goods which are inelastic. Okay, remember, elastic and inelastic, price elasticity of demand, you have elastic and inelastic too. You should always tax goods with an inelastic demand, which means 1% increase in price reduces the demand by less than 1%. Logic being, if you tax the elastic product, taxes will increase the price of the product and the demand will decrease by more than 1%. So that will create higher deadweight loss and the objective of taxation may not necessarily be achieved. 1% increase in price, I'm talking about taxes, 1% increase in price reduces the demand by less than 1%. So when the tax increases the price, demand for the products will go down proportionately less. That is why it makes perfect sense for you to tax goods with an inelastic demand. That's all I want to talk to you in this video. Hopefully it is helpful. Take care of yourself and hope to see you soon. Bye. Hi everyone.